Welcome to this week's Real Estate Q&A. This is where I take 5 of the top comments and questions from our YouTube channel over the last week and discuss them, as well as talk about a couple other things that are affecting people in real estate today. And also in this video, we're going to be talking about that tax lien sales are on the rise. People are losing their homes from not being able to afford to pay their rising property taxes. Okay, welcome back. And if this is your first time watching, I'm Todd Sachs, a real estate broker here in Maryland, and our YouTube channel is dedicated to everything real estate. If you're looking for an agent anywhere in the country, you can drop me a line or go to SachsRealty.com and check out our amazing broker network to be connected with a real estate rock star in your town. All right, so let's talk about what's happening with these rising property taxes. You know, you never truly own your home free and clear. And what I'm talking about here is you still must pay property taxes in all 50 states and DC. So regardless of where you live, and with few exceptions, most of the country has seen tax rate hikes over the last couple of years because of the enormous real estate bubble that we've been experiencing. So to give you an example, New Jersey is the most expensive place to pay property taxes. Their average is about 2.5% of the assessed value is what you will pay every single year. So for example, if you live in New Jersey and your property is assessed at about $500,000, you're paying about $12,400 per year, depending on which city and county you reside. So regardless whether you have a mortgage or not, if you don't pay, you can be foreclosed on for the government to recoup their back taxes. And in some cases, they collect penalties and interest from the sale proceeds as well. Now, if you own a personal residence and you have a mortgage from the bank, they are probably escrowing, collecting from you your annual property taxes and property insurance in advance. It's included in your payments. And the reason that they do this is because the government can override even the bank and foreclose on your property at a tax sale because of their back taxes. So the mortgage company wants to make certain that this doesn't happen, and that's why they collect your taxes in a prepaid escrow. Now, even if you stop paying your mortgage, your lender is going to pay your taxes for you so that they don't lose their asset. As I said, the government takes precedence on collecting their property tax revenue, period. Now, when the city or county doesn't get paid their property taxes, in many states, they can sell your home at an auction called a tax sale foreclosure auction. This is where the vultures, real estate investors, swoop in to steal, buy your property for literally pennies on the dollar. They pay your back taxes and any additional fees in hopes to become the new owner after you have had the opportunity for a redemption period to save your home. So I am not an attorney and I'm not a tax sale expert, and I do know that all states differ on property tax sales, so you can check it out for yourself. But let's check out Investopedia to see what they have to say. A tax sale is the sale of a piece of real estate due to unpaid property taxes. There are 2 types of taxes: a tax deed sale, which sells the property including unpaid taxes at auction, and a tax lien sale, which sells the liens on the property to a buyer who may then pursue the collection of the monies owed. Before a tax sale, during the right of redemption period, a property owner may pay off their tax debt and reclaim the property. Now, let's take a look and see how recently in Genesee County, Michigan, one investor swooped in and bought up a bundle of 230 foreclosed homes, occupied homes, at a Genesee County tax auction, leaving families living in their homes facing eviction. Now, most of these homes, 190 of these homes, are in a place called Flint, Michigan. In this case, these homes ended up in the auction sale after property taxes went unpaid for 2 years. Now, the question is this right for a county or city to do so? Well, many legal constituents believe that property tax foreclosures can violate the takings clause of the U.S. Constitution if you believe in the 4-page document drafted in 1787, ratified in 1788, and in operation since 1789. That same 4-page document was created to establish the government of the United States. Anyways, on May 25th of 2023, the United States Supreme Court issued its decision in a Tyler versus Hennepin County, Minnesota case, holding that a state tax foreclosure violates the takings clause of the U.S. Constitution when it provides no opportunity for the taxpayer to recover the excess value beyond the amount of the taxes owed. This is an important win for taxpayers nationwide. So what is this all about? So in 2010, an elderly taxpayer moved out of her Minneapolis condominium and into a senior community. After that time, no one paid the taxes on the condominium, leading to an accumulation of approximately $15,000 in unpaid taxes, interest, and penalties. The county seized and sold the condominium for $40,000. In addition to the $15,000 in taxes and other charges owed, the county also kept the $25,000 surplus, all in accordance with Minnesota law. Now, Tyler argued that the failure to return the surplus constituted an improper taking under the U.S. Constitution, and the Supreme Court agreed. So I asked, what was the property really worth? Should Hennepin County been allowed to sell the property for only the amount of back taxes, interest, penalties, and maybe a little bit more in the first place? Where is the accountability? Now, the issue here is that many buyers bought at what we realize as the highest prices, guys, ever for a home. They buy payments, what they can afford, and become approved for according to their debt to income ratios. Now, property taxes have been hiked on homeowners, helping to make their already stretched payment even less affordable. Now, the average property tax bill increased from 2021 to 2022, according to adamdata.com. And it shows that in 2022 alone, ready? $339.8 billion in property taxes were levied on single-family homes. Now, will the rate of property tax increases slow down, since property tax revenues pay for the county's expenses and cost overruns on what many consider to be quite reckless spending? Probably not. And this Adam article also says that property taxes continued their never-ending climb last year, with wide disparities continuing from one area of the country to another, connected to varying costs, services, and tax bases. How about this? But on balance, the latest increase nationwide again was modest, says Rob Barber, Chief Executive Officer at Adam. This year's local governments and school systems will face even greater challenges keeping taxes in check, given rising inflation rates and a growing number of commercial properties that could be eligible for tax reductions after suffering a surge of vacancies during the pandemic. Oh, this means that we could see even higher property taxes increase year over year, as inflation has yet again helped to make homeownership even less affordable. So let's take a look at where property taxes hiked the most in the U.S. from 2021 to 22. Metro areas with a population of at least 1 million had the largest increases in the average property taxes from 2021 to 2022, were Pittsburgh, Pennsylvania, up 59.6%. Rochester, New York, up 23.2%. Honolulu, Hawaii, 15.3%. Salt Lake, Utah, 14.3%. And Miami, Florida went up 12.6%. Now, to be fair, there were some property decreases also. Major markets with the largest decreases in average property taxes last year included Philadelphia, Pennsylvania, which is down 9%, Grand Rapids, Michigan, 8.1%, Buffalo, New York, down 5.4%, Phoenix, Arizona, which is one of the reasons I believe that market hasn't completely crashed, they dropped 2.6%, and Tucson, Arizona, again down 1.4%. So before we get into this week's Q&A, I just want to caution you first-time buyers out there that to make sure that you're considering costs like property tax increases into your annual budgets when considering how much home you can afford. So it does matter how much property taxes are going to increase or decrease, as these are not optional expenses to the cost of home ownership. Now for those Q&As. All right, so this first comment says, if only people had listened when I warned them in 2018. And Thomas Jefferson warned everyone far before I. Thomas Jefferson quoted, if the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all property until their children wake up homeless on their continent their fathers conquered. Now, for those of you that don't know, Thomas Jefferson was an American founding father, principal author of the Declaration of Independence, and the third president of the United States from 1801 to 1809. So that's some pretty good insight from President Jefferson from over 200 years ago. Our second commenter says, the market is clearly a huge asset bubble and has been for a while. And yet the banks still lent the money to buy houses which are overvalued by up to 100% and more in an economy which is teetering on the edge of a cliff. It's so crazy, I can't help thinking this is a deliberately planned collapse. You will own nothing and be happy. It's happening. This is a reset. Well, I'd like to bring your attention to something that I found on whitehouse.gov. And it was actually a fact sheet that was published October 27th by the Biden-Harris administration, where they take action to create more affordable housing by converting commercial properties to residential use. It goes on to say that today the Biden-Harris administration is announcing new actions to support the conversion of high vacancy commercial buildings to residential use, including through new financing, technical assistance, and sale of federal properties. Well, maybe they need to sell the federal properties to help them get out of debt. These announcements will create much needed housing that is affordable, energy efficient, near transit and good jobs, and reduce, don't forget, greenhouse gas emissions, nearly 30% of which come from the building sector. Yep, rent and be happy is on the way. Let's not talk about cutting red tape for home builders to encourage the development of single family homes. Why would we do that? You see, one of the reasons why builders aren't building affordable housing is because it takes years and literally millions and millions of dollars to put these communities in. By the time you're talking about the impact fees, reforestation fees, stormwater management fees, and all the infrastructure that goes into it, and the permit costs, and all the building materials that they have to use now to go with these energy codes and things like that. These lobbyists, they were effective. They actually got their products, expensive, high cost products, into the code books so that they have to use building materials that will cost you so much money in home ownership that will only drive cost even higher and drive a bigger wedge in between the people that can have and the people that cannot have their own home. Now these people are going to be crammed into apartment buildings that the government is going to help convert these office buildings. Well, they're going to end up buying them anyway, because commercial real estate is on the brink of collapse, and probably one of the things that's going to bring down commercial banking as well. So, all right, so let's move on to our next commenter. So here's where this subject gets kind of really sticky, right? Because this commenter is responding to a video that I've made. Actually, I've said it on several videos about a home not actually being an investment, that it is a depreciating asset. And this commenter says, I beg to differ on your house isn't an investment. All right, don't let me lose you here because this is written a little wonky. 10 years later, I maybe put there was bad plumbing in the house, but altogether, plumbing, there was some older lights I didn't like, so I went through and put change of style in the lights, made all the difference, blah, blah, blah. What they're saying here is this, because you can't write. I made $80,000 on a house 10 years later when I sold it. So let's say putting $10,000 into it, I still came out with $70,000, which I never would have been able to do if I was renting. I would have got a penny back. So you're saying doesn't make sense to me. You're talking about something that doesn't make sense. Anyway, let's just run down through this scenario. So let's say that you bought a house and you had a loan balance of, let's say, $400,000 after you put down your 3%, 5%, 10%, whatever you put down, okay? At a low interest rate of 4%, like back in the day, that's like $16,000 a year. If you amortize this over the amount of 10 years and you spent over $100,000 on interest payments alone. So you made how much? You made $80,000 in 10 years. You took $10,000 in repairs. Now what? Where does the $100,000 come into play that you paid for interest payments? What about the fact that you probably would spend more than $10,000 in 10 years because by this point, your water heater's probably gone up. Your HVAC, if it wasn't a new home, probably needed to be replaced, and they could be $25,000, $30,000. So what I'm saying here, guys, is the home is a depreciating asset. Number one, I just ran a scenario where, like, if you bought $1 million house today and you paid a 4%, loan back 3 years ago on $1 million house, just to keep it simple, it would have taken like 17 years for you to get half the ownership of the home. Right? So just to own half of the house from the bank, literally you would have to live there for 17 years. So what I'm saying is that owning a home is a lifestyle. The land appreciates. If you get lucky, you get bailouts and see, what happened over the last 3 years. That's not the norm, okay? Where, the government stepped in, saved real estate values, and you saw 20, 30, 40% year over year home appreciation without fixing anything. That, in my opinion, was a one and done occurrence, and it is done. So you have to be satisfied with what you're going to buy. You have to know that if you're going to have any equity in it whatsoever, you need to plan on living there for 7 to 10 years. So I hope that kind of clears some things up as to whether it is a lifestyle or a investment. Because a lot of financial planners say that one of the biggest mistakes people make in their life is they only invest, I guess you could say, in their home, right? How do you get the equity out of it? A real estate investment is actually something that you can depreciate the structure as it's falling apart, which the IRS code does not allow you to do as a owner-occupant, as a homeowner. You would have to be a real estate investor to get the benefits of depreciating the house as it's falling apart, or that you're making repairs, being able to write that off against any income or cash flow that you make. So unless you're investing in real estate for cash flow, it's not really considered an investment. So that kind of leads us into the next comment where we're talking about renting. So this commenter says, I'm not an advocate for renting. I don't believe it's good advice to continue renting as a general statement. It's not always a cheaper option. Now, guys, I'm not saying that I'm a fan of renting, but what I am a fan of is for you to be able to afford your bills and the roof over your head. And a lot of homeowners over the last several years, especially these brand new first-time buyers, they really had no idea what they were being pushed and pressured into. And I tell you, if you interview some of them, many of them, they would tell you that they were much happier renting their 800 square foot apartment and paying a third of their utility bills and a huge amount less for their housing than they do right now. And a lot of these buyers, a huge percentage of them over the last several years, are in remorse. So what I'm telling you guys is, look, save your money, see what happens over the next couple of months. If you don't have 6 months in the bank after you pay all of your moving expenses, you pay for your boxes, your mover, anything that is related, your down payment, your closing costs. If you don't have 5-6 months of savings in the bank to cover all of your expenses, you may not want to jump in just yet. And then finally, on the contrary, our last comment says buying a house for most folks at this point is a bad idea, at least until they have a family and some stability in their lives and don't plan on moving for quite a while. And that pretty much summarizes what I just said. So as you can see, guys, when I read the comments, there is a huge diversity in opinions, and that's fine. I love it. Keep those comments coming. You never know, your comment may be on next week's Real Estate Q&A. I wish you well. Thanks for watching. If you liked the video, you can smash that thumbs up. It'll let me know that you did. And guys, what are you waiting for? If you haven't subscribed to my channel, log in. Create a Gmail account if you don't have one, whatever it is that you want to do, but subscribe, hit the alert bell. You'll know every time I upload content. And finally, one of the worst things you could do is keep all this content to yourself. You may just be saving somebody from getting into a financial disaster by listening to what you're not going to hear on mainstream media. So share this video with your family and friends. The share button is right here. See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.